Hi guys, hope everybody's well. Tuesday 17th of August, and slightly more positive feel about things this morning in the markets. Just have a look at my charts here. Really what we've seen is the big kind of flight to quality move last week that led to all risk assets moving lower. You can see on the three charts I've got here, equities, oil bottom left and euro dollar bottom right, all looking fairly similar. In fact, all looking very similar. So a general flight to quality last week, after the non-farm payrolls, after the Fed's extension of QE, after some bad Chinese economic data suggesting a bit of a slowdown in the Chinese recovery, led to across the board a removal of risk appetite. And what we've seen really since that big sell-up, the big move was Wednesday. Since then, things are stabilised, and really we've been consolidating Wednesday's big move. And so for the last few sessions, in fact, we've been ranging around about the lows we hit on Wednesday. And yesterday we were, it was very much the same pattern. We were ranging around about Wednesday's lows. It was a very uneventful session, as we expected. Mondays in August, mid-August, tend to be very quiet affairs, and yesterday did not disappoint on that front. We did get a couple of bits of economic data. Let me bring up my equity chart in a little bit more detail. We had a couple of bits of economic data, which were both actually, if anything, slightly worse than expected. Nothing major, but the Empire State Manufacturing and the NAHB housing index were both slightly lower than expected, and that's really what led the markets down to the lows. And in fact we set a new sort of 4 week low for equities, dipping below Friday's low, and we got down to 1066.25. That was just after the cash open on the S&P, because actually at the same time, and probably what created the biggest move of the day, was a little bit of a scare concerning Portugal and their debt funding situation with the ECB, and that just brought a little bit of a scare to the markets, and we thought potentially we'd return to that flight to quality trend that we'd seen last week, but it turned out to be a false breakout to the downside, and we very quickly reversed that and got back into what has been a pretty consistent range over the last few sessions, ever since the big move on Wednesday. And generally speaking, that was it. As far as yesterday's session was concerned, we drifted higher, and we managed, reasonable move into the close, got us back into kind of the bulk of what has been a very messy, choppy consolidation of those losses. Now, this morning, the mood's definitely improved, I would say. And really, this started off with the Asian session last night, which was after a little bit of weakness. We saw reversals and the Asian stocks moving back through break-even and actually finishing higher. The main real story from the Asian session were comments from the Bank of Japan, and continued speculation that the Japanese Prime Minister Khan and the Bank of Japan's Shirakawa are to meet next Monday, and there's calls for further stimulus measures. So this is the whole story that's been running yesterday and today about, will the Bank of Japan intervene in their currency? We've seen the dollar versus the yen hit 15-year lows last week, and the appreciation of the yen has been hitting the Japanese exporters very, very hard, and it's become a problem, and they need to think about starting to address it. And if the dollar yen hangs around the 85 level, I think they will step in and do something to try and address that issue. So they're meeting on Monday, and we may well get an announcement on that front. But that's certainly helped Japanese exporting stocks, as they've taken a boost from this, because they've really been suffering from the appreciating yen. So that got the session underway on the front foot. Since then, we've had mainly the good kind of risk appetite this morning has come from the auctions, and particularly the Spanish auction we had, which was very, very good actually. So they auctioned off 4.4 billion euros worth of T-bills, 12-month T-bills. The bid to cover was very healthy at 2.47. We'd been expecting, well, the last bid to cover for that 12-month auction was 1.95. The yield was a lot lower, 1.83 versus last time 2.22. So really healthy bid to covers and really healthy yields on the Spanish auction. Also the Irish auction came in pretty solid, and actually that's Ireland. They're now 99% funded for the whole of 2010. So the bond auction's doing a good job this morning, which has led risk assets higher. Couple that also with we had the German zoo economic conditions indicator. Real mixed bag actually. The current conditions number was phenomenal. Came in at 44.3. It's almost double what was expected. Expected was 24, and last month was 14.6. So, you know, really from going off last month's number, it's tripled. Okay, so the current conditions in Germany are absolutely fantastic. However, the economic sentiment, i.e. the forward-looking picture, was the opposite. It came in at 14, which was much lower than the 20 that was expected, and much lower than last month. So what we got here is a situation where the weak euro we saw for a lot of the summer has really benefited the German exporting industries, and this has boosted output considerably, and therefore the current conditions in Germany are phenomenal. However, they don't see that continuing. Obviously, we've seen the euro appreciate against the dollar again. If I bring up my euro chart here as I'm talking about this, might be a good idea. But we've seen the euro appreciate in value again against the dollar, and therefore, going forwards, they're not going to get quite the same benefit out of really cheap euro as they have been in months gone by. So a bit of a mixed bag from Germany, but overall the auctions doing their job. We've also had some UK inflation numbers, came in at 3.1%. There's been a lot of talk about UK inflation this year. The Bank of England at the start of the year expecting it to drop back below 3%. However, it hasn't done that, and it's remained stubbornly high. And obviously, if it's above 3%, the Bank of England have to write a letter to the Prime Minister explaining themselves why they've allowed it to remain above that 3% level. Their target is 2%, and at the start of the year they were saying by this time it would be back towards that 2%, but it's remained stubbornly above 3%. This is the reason why one member of the Bank of England's sentence has been calling for rate hikes to address this inflation issue. We've got a VAT increase at the start of next year. VAT is going up to 20% in the UK. This is only going to add to upside pressure on inflation. However, having said that, the Bank of England are still remaining stubbornly confident that the medium-term outlook for inflation will be back towards 2%, if not below 2%. Okay, but they have said they are surprised that inflation is still this high at this time. So inflation numbers out of the UK, that was earlier on. But as you can see here on the euro, coming off the low from Monday overnight, we have been trending higher. We're still within the range, the consolidation range, following Wednesday's big move. Okay, so the key level really for the euro is 129.32. We haven't quite got there today. We did get, my target earlier on was yesterday's high, which was 128.71. We got above there following the good auctions earlier on, but we've since dipped back below. Okay, my entry level was the pivot, but we haven't quite got back to that point yet, but we may do, especially if we get some bad US housing data, which I'm going to talk about in a minute. But really that euro picture, let me go back to stocks, because it's really the picture across all the asset classes. We're still within the range, the consolidation range, but we're edging back towards the top of it. Okay, so this morning, slight turn back towards positive sentiment. We've been drifting higher, and the key level for equities is Friday's high, and that's at 10.89. So my entry points worked pretty well so far. 10.81.50 was yesterday's high. Okay, coming off there, we got our first target of that Friday high at 10.89. If we can break above there, that may well lead to a further moves higher. 10.99 would be my second target. But as I said in my strategy report that I emailed out. You know, the housing data is pretty key today, and that's at 1:30, and we cannot fully commit ourselves to a return to positive sentiment until we get that economic data out of the way and it's not bad news. Also, same goes for the industrial production numbers we're going to get at 2:15. So the housing side of things, let's talk about this further. It's been desperately disappointing in recent months. Ever since the US tax credit stopped at the end of April, we've literally seen activity in the housing market fall off a cliff. Every month since then, we've had desperately bad numbers. Now, can we see an improvement? Can we see the housing market in the US bottoming and beginning to rebuild itself? Okay, and today we've got two economic data on housing